What is an elimination entry? An elimination entry is a special type of journal entry that removes transactions between companies that belong to the same corporate group. Think about a parent company and its subsidiaries. Even though they are separate legal entities, together they function as one economic unit. And because of that, any internal activity, like selling to each other or loaning money, shouldn't appear as real revenue, real expenses, or real assets when the group reports its financial statements to the outside world. So elimination entries clean that up. They help us show the true financial picture, not inflated numbers and not double counting. Just the real activity, with external customers and external lenders. Why elimination entries matter. Now, let's talk about why they're important. Without elimination entries, the group might show revenue it didn't actually earn. It could show expenses it never really incurred. Assets could look bigger than they truly are. And liabilities might appear even though the group doesn't owe anyone outside the organization. Elimination entries prevent all of that. They protect the integrity of the consolidated financial statements, and ultimately, they help us present a fair, honest, and accurate picture to investors, lenders, and regulators. What gets eliminated? So, what types of transactions normally need elimination? Here are the big ones. Intercompany sales and purchases. Intercompany loans and interest. Intercompany dividends. Unrealized profit in ending inventory. Unrealized profit in fixed assets. These transactions are perfectly fine on each company's individual books, but they're not appropriate when we look at the group as a whole. How to apply elimination entries, step by step. Let's walk through how you apply elimination entries during consolidation. It's actually a pretty smooth process. Step 1. Identify intercompany transactions. Start by reviewing the trial balances for each company. Look for signs of internal activity. Sales between entities, payable receivable balances, internal loans, interest, or dividend income. Step 2. Determine what needs to be reversed. Once you've identified the internal transactions, ask, which of these inflate the consolidated numbers? Anything that affects revenue, expenses, assets, or liabilities needs to be eliminated. Step 3. Prepare the elimination entry. This is important. The elimination entry is not recorded in any company's actual accounting system. It's only recorded in the consolidation worksheet, the place where all financials are brought together. Example 1. Eliminating intercompany sales. Here's a simple example. Subsidiary A sells goods to subsidiary B for $50,000, and A's cost was $30,000. B hasn't sold the goods yet, so the profit is not yet earned by the group. The elimination entry looks like this. Debit sales, $50,000. Credit cost of goods sold, $30,000. Credit inventory, $20,000. This removes the internal sale and removes the unrealized profit. Example 2. Eliminating intercompany loans. Another common example is internal loans. Let's say the parent loans $200,000 to the subsidiary. On consolidation, the group doesn't owe itself money, so we eliminate both sides. Debit loan payable, $200,000. Credit loan receivable, $200,000. Simple, clean, and accurate. Example 3. Eliminating intercompany dividends. Here's another one. Intercompany dividends. If a subsidiary pays dividends to the parent, that's internal. For consolidation, debit dividend income, credit dividends declared, and the internal dividend disappears. And that's the heart of elimination entries. They exist to remove internal transactions and leave behind the real, true economic activity of the group. Once you understand the reasoning and follow the step-by-step process, it becomes much simpler and even logical. If you found this helpful, please like the video, subscribe, and tap that notification bell. And let us know in the comments if you'd like a full breakdown of upstream versus downstream eliminations. Thanks so much for watching, and we'll see you in the next video.